of the property's value every single year, whether you're living in it or not. Number 4, property taxes, every year, regardless of whether the property is generating any income for you. And number 5, and this is the one people underestimate the most, liquidity. If you need cash next month for an emergency, you can't just sell a house. Finding a buyer, negotiations, paperwork, closing, that's typically 2 to 6 months minimum. And if you need to sell fast, you're almost always taking a lower price for it. Now let's talk actual returns. Long-term average property appreciation historically tends to land somewhere between 3 and 6% per year in most stable markets, after adjusting for inflation. There are always exceptions, certain neighborhoods that boomed, but those are exceptions, not the rule. And remember, that's the gross number. Once you subtract maintenance, taxes, and interest, your actual net return often drops to somewhere around 1 to 3%, sometimes even less. But, and this is a big but, real estate has one thing stocks don't offer directly: leverage. You can buy a $500,000 property with just $100,000 of your own money, and the bank covers the rest. So if that property appreciates 10%, you're earning that 10% on the full $500,000 asset, not just your $100,000. That massively amplifies your return on the money you actually put in. This is called a leveraged return, and it's the real engine behind real estate wealth. But remember, leverage cuts both ways. If prices fall, your losses get amplified just as much. Now let's flip to the other side, the stock market. The hero here is compounding. And understanding compounding matters because it's the single biggest reason Warren Buffett became one of the richest people on the planet, not by picking hot stocks, but by staying invested for decades. If you invest in a broad index fund, something tracking the overall market, the long-term historical average return has been somewhere around 8 to 10% per year over multi-decade periods. Some years it's up 25 to 30%, some years it's down 20%, but averaged out over time, that's where it lands. Now watch how compounding actually plays out. Say you invest $50,000 as a lump sum, and it grows at 9% annually. In 10 years, roughly $118,000. In 20 years, roughly $280,000. In 25 years, roughly $431,000. That's without adding a single extra dollar, purely from compounding. Now add in regular monthly investing. If you invest $500 a month for 25 years at that same 9% average return, you'd have put in $150,000.